Okay, folks, welcome back. So I apologize for being a little bit late today. I said I'd have it posted during the 3 o'clock hour, my local time, but as you'll see when we get to cable, I was already recording something, and it'll be self-explanatory. So if we're looking at the dollar index on the daily chart, let's zoom in a little bit here. All right, so we have our level here, the day that washed out this low, but not on a closing basis. We have not traded through that. As long as we stay above this, that I'm looking for it to trade up into here. Okay, so we'll have that added. And I'll try to keep the annotations short and concise, because tomorrow we have a rate announcement for the GBP. Okay, so that's like the main hitter for this week for me. We have FOMC behind us now. It looks like it wants to trade up from where we are. I would like to see that happen. If we trade up to this level here, it's in my opinion, it's a rather ambitious trade for tomorrow. But by Friday, should we trade up to this level, the next one would be right here on this low. There. Okay, so it's that imbalance there that would fill. Otherwise, right now, initially, all I'm looking for is this. Really just to get above this high here. So how we trade here, if we trade there at all, because I could be wrong, but I'm still staying with that bias. And you can see I've been executing basically with that bias in mind with the trade examples I've been posting on YouTube. So I've only been selling short. And even though the dollar hasn't moved all that much higher, it still works. And that's what I mean by having a bias. It doesn't have to be a buy the low, get out at the high when you're bullish, or sell the high and get out the low when you're bearish. You just have to work within that expectation. So that way you're not flip-flopping back and forth or confusing yourself as to what you should be doing. And if you're trying to be nimble, okay, trying not to get too many pips over staying your welcome, it's a rather lucrative way of operating with intraday price action. So we're going to stick with that narrative. On a near-term basis, we have this high here. I'll change that a little bit different. And we'll drop down into an hourly chart. I promise not to take too much of your time today. I gave you a lot yesterday, even though you are mentorship. The ideas of market structure breaks and such. I know a few of you in the past couple months, you've been emailing me. Could you talk a little bit more about market structure and how to know when it's valid and all that such? That lesson was directed at most of you in the mentorship, and also just to showcase the importance of knowing what it looks like. Now, obviously, there's so many other things that go along with it you're learning in the mentorship, but it's a big help to anyone that's sticking their toe into my content and not just falling in and drowning. All right, so we have the market trading above these highs here. And there's been a lot of give and take, and that's typical of FOMC, but we finally made it above here. So now what resides over here and here? So we have these two highs, and you know what this high is, right? That's your low resistance liquidity run signature that we like to look for, a lower high than the one to the left of it. So we have this level here to watch for, and then we have the remaining SIBI, sell side imbalance, buy side inefficiency here. That closes real close to the last up close candle on the hourly chart. So that's a bearish order block, and it's also overlapping very close to the complete closure of the SIBI. Okay, so we have, we'll just use the low. I'm not going to use the order block. And originally started there. So we have to use the measurement between that to get consequent encroachment. So So it looks like we have 93.48. Look at that. I couldn't have done that if I was trying. Alright, so let's make that a little thinner. Try not to be so heavy with it. And we'll get rid of this. And there we go. We're all cleaned up now. So it could, if it finds continuation on the upside, we could trade above these highs here and hit consequent encouragement, and that might be the end of it. It may not even trade above this high, but if it does, we'll go to the level that's on the daily over here at 94. All right. We do have these lows in here. Wish I would have seen it trade down a little bit lower than that and then reject it, but we had multiple instances of trading below the rejection block, which is the lowest close on this price swing. So we had it here, and then we had this one trade below the rejection block there. So it's enough to see that run here. We traded up so far into the bearish order block here, and we do have low resistance liquidity run signatures here and here, still residing in the hourly chart. So while that's not always a guarantee, it just gives us the added confirmation that it's more likely to, not a be-all end-all panacea. It has to happen. It just means that we could potentially see it. Now, don't forget, we're in a large consolidation on the daily chart. So all of this business here, I could be completely wrong, and we really just traded above these highs, and all of this is a fake run, and then trading down below these equal lows here. That could happen. That's how I would be wrong. Okay, so I have that in mind should we start to break down. If we get below this gap in here, this fair value gap, if we trade down below it and come back up into it, that might act as resistance should price break down from the time you watch this video until we speak again on Friday. That would be an area that I would take a short on dollar, not selling dollar, but going long foreign currency on the basis of that, and then looking for this run below here. Otherwise, I'm staying with the narrative that we've been seeing me hold for a couple weeks now, looking for modestly bullish prices on dollar. Finally dropping down into the 15-minute time frame, and you can see all the business here with FOMC. Ran the lows here, but not as much as I would like to have seen it. Fair value gap in here, bullish order block. We traded down into that during the 2 o'clock news event, and then we took it above here. So we'll see. It needs to hold on to it. If we lose it, then everything I outlined on the hourly chart would be the opposite, and I would be wrong. But I'm telling you how I would operate with it should it unfold as I indicated on the hourly chart for dollar. All right, let's go over to euro dollar. All right, so here is the euro on the daily chart. We'll zoom in here. And we're still in this large consolidation, and it looks encouraging that we may make a run below these lows here. We have a low at 117.54. Then we have a low over here at 117.11. We'll call it 17.10. Below there's liquidity. Small imbalance there, so we'll have that on our chart. And it needs to be a little bit more punchy so it stands out. You like that? Punchy? I don't know where that came from. And near term sell side liquidity pool is right below this low here. So we'll have that also. And we'll just use a little bit different blue. And that's the side of the marketplace I'm going to stay with. We came up and closed in the imbalance here as indicated, and we're going to look to see if it wants to roll over. It certainly looks like it's trying to do so, but we're going to have a very passive approach to bias on this and stay with the short-term bullishness on dollar. So therefore this one should bend a knee. If that does in fact occur in dollar higher prices, then we should trade below this low and attack the liquidity over here and a point of rebalance there. Now it could trade down below all these lows, close in this imbalance or consequent encroachment between this low and this high, split that range in half, it might just trade down to that. And that might be what it's doing, is coming down, clearing all the sell side liquidity, and then it might surprise and have a continuation lower on dollar and higher prices on euro. So that's within the realm of possibility, but for right now, I'm not trying to hard sell that narrative. I'm just saying, for the purpose of recording and having it in record, it might be doing that. But between where it's at right now and down where that would be, there's opportunity for pips to be harvested. So let's go down to an hourly chart, and you can see all this business. All right, so we have the market creating a nice high, ran the rejection block, the highest up close in this swing, hits it, runs lower, bear flag for retail traders, it gives them that and then runs it up into them. And we have a fair value gap and bearish order block. Now for your notes for framework and setups, this is one that repeats a lot. So if you're looking for your pet pattern or your pet setup, if you're looking for a bearish market environment, you have a fair value gap there, and then you have a bearish order block. And we'll have that with a more pronounced line here. Okay, so the idea is it needs to trade up into a premium. You know what that is. We have to look at the range. There you go. So 50 is here. So it goes to a premium on this candle here. Do you sell short there? No. When it trades up into the bearish order block and taps into the fair value gap for institutional order flow entry drill. So the high on this candle, well, you've already seen the 50 level. Let me take this off because it's getting too busy. The high on this candle here at 118.81 and 7 pipettes. All you have to do is see that price print. So how could you trade with that? Well, to ensure you get a solid fill, you could put your order in at 118.80 institutional, and the high on this candle comes in at 118.82 and 4 pipettes. So you have that pattern there. There's your entry technique. Okay, so you have multiple things that I teach, but it gives you a complete system. Your first target would be below this low here, and you would let it ride to see if it has any more. What targets would you use? You go back to having the fib on here. You can see we clearly hit 0.5 negative standard deviation. We hit that, and if it continues lower, we could be looking for one standard deviation at 117.56 and 7 pipettes plus 5 pips. So that would be 117.61 and 7 pipettes. Okay, so that would be the next downside objective. And at that point, 80% of the trade should be taken off. All right, so if we were using this for the current environment where we're in consolidation, it isn't really hard directional bias, one-sidedness, you would be taking at least half the position off here at first target below this low, and something at least 25% of the trade or 20% off here. So a small portion here, aiming for this. The bulk of your trade should come off at this one, because we moved a considerable length of distance below this low. As it trades below that low, you take something there, because it could come back in the consolidation or altogether reverse because of the current environment. But once you take something off, then the largest portion that's in the remainder of the position, that needs to come off, about 50% of that. So in this case, it'd be close to about 80% of the trade from the original position that you would sell here. That should come off there, and then you would let the rest ride with a break-even stop with 20 pips or so on locked in. Okay, so I just gave you a complete pattern approach and model. And for some of you, that might be, oh, that's the one I want, or I've seen that in my studies. I can't believe you just confirmed it. That's the type of thing you end up getting. That's your aha moments. For some of you, maybe like, I've never seen that and I'm not looking for it, but now you might see it because we've covered it here. So what you're learning here is a combination of PD arrays that overlap within a probable narrative. The market's likely to go lower. So if it's going to go lower, How can you structure a trade around that? Well, you have an imbalance here in the form of a sell side imbalance, buy side inefficiency, fair value gap. It is a premium PD array because the market's trading down here and it's rising up into it. And what time of day is that? That's the end of the London Open kill zone. Okay, so it would fill you right at the time the London Open kill zone closes. Is that a bad thing? No, it's still within the kill zone. And the market starts to drift lower. So you can see how the market does in fact pan out pretty good. It just gets wonky around the FOMC release at 2 o'clock, which is typical, like non-farm payroll event. And now we'll drop into a 15-minute time frame and get a little bit more in here. There you go. It looks much better, doesn't it? All right, so you can see that pattern here, highly precise. We have a break down here. And now think about what I showed on my YouTube channel yesterday regarding market structure. So now we're working with a 15-minute time frame on Euro. So this area here where it trades up into the bearish order block and it trades up into the fair value gap, that would constitute a short based on that hourly chart and the current narrative, with price likely to go lower because dollar might be going higher. As it trades up into that level or that PD array, what price swing do we use? This low. This low is your breaker that's in here from this high and this high, and it's also your point of reference for your market structure break. So if you look at that in regards to how to trade this pattern, say you missed your pet pattern and this was your pet pattern, okay? I get this question a lot. If this is the pattern you're looking for and say you miss it, do you just forget it and just say, I'm not going to worry about it no more, and I missed it because I didn't get in here? No, you don't do that at all. You wait for the market to come down below that. There's your breaking market structure. Is it breaking market structure here? No, it's just going down below it, coming back in. It needs to come down through it. Okay, once it comes down through it and then come back up into it, there's your sell. How could you use this? Well, we have the same pattern over here that is outlined, where you have a fair value gap and a bearish order block with a narrative that's bearish. That's occurring here again. Remember, on the hourly chart, all these levels here, okay, if you're not following me, what I'm about to show you, just rewind the video until we start talking about these levels again on the hourly chart, because what I'm showing you here is the same fractal that's occurring right there. All right, so you can see that same pattern, fair value gap, bearish order block, trades up into the bearish order block and closes in the fair value gap in the form of a sell side imbalance, buy side inefficiency right in here. So you could be a seller at this candle's high and allowing for price to move this much against you, and your stock could be just right above this candle's high. And then you ride this run out. Relative equal lows, liquidity pool resting below that. There it is. That's operating on the context of the 15-minute time frame within the larger narrative on the hourly chart. So the hourly chart might be, some of you, this is your model. You trade on an hourly chart, there's your setup, there's your pattern. Others that are more comfortable trading the bellwether time frame that I like to use is 15-minute time frame. There's no magic in these time frames. They're all doing the same thing. But this setup here is the same one that's over here on the hourly chart. Because we're working within the narrative that the dollar is slightly bullish, the foreign currency market should be bearish and this sell off. But this is your framework using what you learn in mentorship. And then the market breaks down. We have a small little imbalance right in here. Okay, and with the market trading up into that, we have not that. There we are. So we have our fair value gap there. Beautiful consequent encroachment. Bang, hits it. Optimal trade entry, high, low, bang, hits it. You can see it's 15 minutes ahead of the 2 o'clock FOMC. Hits it, and then we run lower. And right below here, sell side liquidity pool. So shorts always try to cover below old lows, and you're pairing up your orders with smart money. So Nice little ditty here on euro dollar. So now you have a confirmation of a pattern that you may have been observing, and also how to use it within the hierarchy of time frames from hourly to 15-minute time frame. They repeat. If you're on the right side of the marketplace, these patterns will repeat. And because of their fractal nature, it's powerful because it gives you visibility, and you know how to see these lower time frames submit to the higher time frame. But they in themselves will have their own patterns as well. So it's just a beautiful way of interpreting price action, and it's the real market. It has nothing to do with indicators. It's pretty neat. I gotta convince you, right? All right, so let's go to cable. All right, so here is cable, British pound versus US dollar. It's our daily chart. You can see we have completely came back up into this down close candle, and let's zoom in a little bit. All right, so we have a breaker here. Okay, so that might be what we end up trying to reach for if we go overnight into some kind of a buy program. We have rate announcements tomorrow, so it could punch up into that. I'd rather see it not do that. I like to see it keep this area open and not even trade back to the breaker, because there's a lot of folks that would see this as support broken, and let's see if we can come back up and find a retest of that. I'm thinking if it goes up to there, it's going to come into this a little bit more aggressively and break all those hopes and dreams of support and resistance traders. So again, that may sound mean and cruel, but again, if I was making the market for cable, I would do that. But actually, before I jot down, the short-term low is the next objective on downside, to trade through that, and then we have a small little imbalance here with a bullish order block. So if we get some craziness on the downside, that would be a level I'm looking for. And again, consequent encroachment between this high and this low. It's a little bit lower than this one, but the order block is really what I'm focusing on, that we get below this swing low and short-term liquidity pool for sell side. On the hourly chart, okay, you can see price has had a nice attempt to get higher. I traded in here, as you'll see, and this is what kept me from recording a little bit earlier. I've been waiting for this thing to break down, and I took first profit, aiming for 40 pips. I was just like a couple pipettes below 40 pips, but you'll see when we go into the 15-minute time frame. I'll add all the orders and stuff back on. But if we trade down to here into this buy side imbalance, sell side inefficiency, I don't want to see any respect of this. So if we do go lower, I don't want to see any respect there. I want to see it target these lows and then close up into this buy side imbalance, sell side inefficiency, and mean threshold of the last down close candle. That's what I'm aiming for the trade I'm in. It may stop out because what I'm seeing here on the hourly chart, I don't like that, but we'll see. But that's what I'm aiming for the next short-term price swing. So it's about 100 pips or so, and 15-minute time frame. Let's zoom out a little bit. A lot of muddy price action in here, and it's because it's ahead of its rate announcement, and it's in FOMC. So it's a lot of business in here. I think personally, all of this is building in a premium, and it's going to be a hard hold if it's going to break down. That's why I took a lot of the position off, as you'll see when I drop into a 5-minute chart. I just think these levels are just really too tempting to clean up and knock that out. If I'm wrong, whatever we do tomorrow sets the stage for an eventual run to this. Okay, so in other words, say I'm wrong, I stop out on my open position short in this pair. If it goes higher, it trades up into that level there. And then that might create a level for shorting that targets this at a later time, maybe into next week. Okay, so something to consider and be mindful of. We have a small little fair value gap in here. We have a small little fair value gap in here. So if we trade down into that, I have to be careful also, because that might get a reaction and everything I'm looking for gets deferred to a later time. And let's drop into a 5-minute chart. Okay, and I'll add the positions and the executions. Okay, you can see I sold short here. It's 2% of the equity I'm using. So my stop was above here. Got real close to it. I wasn't watching at the time, but it got real close to it. Didn't stop me out. And I took my first partial here. So the bulk of the position was taken off there. Just you can see the entry, look at the price. 129.85 4. So 85.4 and 49.8. So it was real close to 40 pips, but it is what it is. I had it a little bit lower here, and as I was watching it dropping, I was waiting to see if it can get into this here, and I would have taken profit there. But partial's there, stop is here, and if it stops me out, then whatever. But a pretty nice chunk of pretend monopoly money working within this range. Okay, it's just me practicing in really hard environments. That's all I'm doing. Is it something you should do? Yes, you should do it. You should see it and then feel what it's like to hold on to these positions when you're trading against impending news that's going to occur tomorrow and through FOMC. I had the position here ahead of FOMC, and it was being held through all of this, but now it may come up and stop me out, and that would be fine. I don't care, because it's already taken a large portion of that trade off. Now, I don't do this with live funds ahead of news drivers. I do it to solidify the things that I respect in the marketplace, so that way, despite whatever I might see, or because I see a lot of people on social media, because people send me to them saying, are they teaching your stuff, or is this happening over here? I end up looking at what they're doing, and invariably they're saying what they believe about the marketplace. And then whenever I hear someone's opinion, my mind switches to what's the opposite side of that trade. So it just keeps me grounded, where I might do this with a demo or a paper trading application like we use on TradingView, just to scratch the itch. Okay, and really that's what was the context of why I'm even in this trade today, because otherwise, you know, the protocol. I don't trade with live funds with this environment. We don't trade ahead of FOMC. If we trade it in London, it has to be squared by New York, and then we just let the price do what it's going to do, because probabilities shift from high probability in price action to low probability ahead of FOMC, because it's that carnival ride where they run liquidity out. They'll run for it. And I was surprised that it didn't take my stop, because it got really, really close, and it didn't. So when I look at things like this, I don't puff my chest up and start peacocking around the house and tell my wife, see who you're married to? I don't do that on these types of setups. Now on other ones I do, and you know about that, but nonetheless, for these types of things, I'm not going to put this one on YouTube, put it that way, because for me to do so would imply that, or someone would watch it and say, oh yeah, he trades FOMC, where I really don't. But this was just me operating here, so I could send it to the person that asked me to take a look at their view, because they were buying it up in here. They were looking at this as an optimal trade entry, fair value gap, and they thought it was going to go higher. So I went right in there and faded that. So that's the real story behind that. And because I was recording it, I can't record with another recording running. So that was what was going on. So I'll stop the discussion here on British Pound, and I'll splice in the recording for what was going on here, so you can watch the price actually move around. and then we'll go into another market. But for now, everything I've covered here for British pound, I've already said. So I'm not looking to trade ahead of the rate announcement tomorrow, but if we get a nice imbalance tomorrow after the news event releases, then I might have something to work with. But for now, I'm just going to sit on my hands and wait to see if there's any kind of displacement. So, because I don't know if it's going to continue higher from here, or if it's going to go into this overnight, and then that gives us a reason to go higher there, and then they use the rate announcement as a driver to send it up into the 130.50s, maybe 130.60s or 70s. If I'm wrong, it could do something like that. But if it does do what I think is all this is built-in premium ahead of, and it might not be done, it might go higher, but it may be just them building in a premium for their rate announcement that may be viewed as a disappointment and may go lower. So that's one of the scenarios I'm looking at as a potential narrative to operate until tomorrow. Okay, but until they release the decision on what they're going to do with their rate in the Bank of England, and then what we see in market structure tomorrow, at the time it happens, it's a 50-50. So we know what 50-50 is around here. It's a no touch. We can watch it and demo it, but it's not something that we build in as an idea to do with our live funds. We want really, really obvious things that are one-sided, heaviness to one direction that's easily outlined with one side of the marketplace. Okay, so that's what we try to focus on here, and hopefully that this hasn't confused you or enticed you into start trading ahead of FOMC. But there's no difference between this and when you see me do it on non-farm payroll on my YouTube channel. Just because I can do it once in a while, it's like Murphy's Law. If I go in with live funds and trade non-farm payroll, it's going to be the non-farm payroll that it runs and clears my stop, and then I'm going to be regretting it. And then I will live that moment over and over and over again in my mind for 12 years because I knew better. Okay, because I'm obsessive. So I have to have these hard and fast rules and processes to keep me from going insane, because I literally will nitpick over and over and over again something so minute, something small, and it's like that little piece of meat and you have steak between your teeth. Until you get home and get that floss to get that out of there, your tongue's going to keep going right back to it. And if I make a mistake and do things that I know I shouldn't do and break my protocols, it drives me mad. So that's why I have to be highly disciplined. And I'm not as patient as you might think I am, because I know what could potentially happen in the marketplace, but I am highly disciplined. So the discipline overrides my natural impatience, because I want to go in and do what I know I can do, and I want to get it done quickly, because that's my personality. But the discipline that I've had to forge, and the market forged in me through losing lots and lots of money, that discipline reminds me all the time that while this is something I do as a way to combat the things I see because of me being involved with social media and having people around the world, when they send me someone that's trying to do things with this content and they don't know what they're doing, the way I deal with that is, okay, they're trying to buy something, well, I'm going to go in and do the opposite. So it kind of gives me that, I don't know if it's the right word for it, but satisfaction. It's kind of like an ego thing for me. So I do that like I used to use Twitter. And it's just a way for me to say, they watched their trade fail, but my trade works. Okay, because I know more than they do, and they just because they see something that looks like an optimal trade entry and it has a fair value cap doesn't mean that it's a buy. So they're trying to buy something at a high premium level, which again, you have to understand everything. You can't just take one little piece of something I'm teaching and walk away and say, oh yeah, this is easy, I know what I'm doing, because it will hurt you. And that's why I rag on these guys that are on YouTube trying to parrot what I say, because they're harming people. And for some of you that email me, say, why do you keep doing this, and why do you keep saying it, why do you keep talking about it? Let them fail. Because think about how you would feel if you saw someone talking about the things that I teach and they show only the hindsight examples and they're teaching it wrong. you could be hurt by that. And I feel responsible, even though I'm technically not responsible for them listening to someone else, but I feel that sense of responsibility. And I don't want anyone hurt, especially by something that I authored. And just because these goobers out here try to, press upon the public that they can do it, if they start talking like me, then naturally, oh yeah, he must be one of those secret mentorship guys and he's trying to teach it. So I'm going to subscribe to what he says or she says. And they end up hurting the audience because they're telling them something that isn't true. And then there it is, it's done. They harm themselves. And who's the victim in that? The person that's listening to someone that doesn't know what they're doing. And then what opinion is formed after that? Oh, this stuff doesn't work and ICT's full of crap. So that's what goes on in my mind, and that's the things I think about all the time. And honestly, I wish I didn't care, because it would be so easy just to go through life and not worry about other people. But I worry about people because I don't do this to look smart for everyone else. I do this because I want people to do better and to not struggle while we're here. And if they can make it easier for their family and teach this to their children to pass it on, that's really what I want. So anyway, a small little rant there. I don't want to go too far into that, but let's take a look at gold. I know I mentioned I was going to take a look at gold the other day in the last video, and I never made a point of going back into it. And thank you for those that usually come back and email me and say, hey, you owe us gold. So it went over your head too, see that? But let's talk about gold for a moment. All right, so here's gold on the daily chart. Now, you can see we're in a holding pattern. It's just sitting here. Now, I don't have a whole lot to say about gold, but I'm going to say this. Think about what the dollar has been doing. And we're looking for that short-term little bullish pop up into that fair value gap on the daily chart. I'm not exceedingly bullish on dollar. Okay, so gold may be holding in a consolidation and allowing the dollar to work out its near-term bullishness, and this consolidation should be maintained. Now, it could drop down below these relative equal lows and go to the consequent encroachment of this wick or tail. It might hit that and then go higher. I'm still bullish on gold, and if everything happens like I believe it might in the coming months going into the end of the year, I firmly believe that 3,000 gold is possible. And that's just the beginning. Like if it gets really crazy, we could see 4,000, 5,000 gold. And now it sounds nuts, but with all the things that are working themselves out in probability, that might be what we end up seeing on gold. Now, is that a go in and buy gold right now? No. We have to weigh out what dollar's doing, and dollar is the key to unlocking this market because they're inversely correlated. So if dollar goes up, gold can stay in consolidation and not drop by much. And if it does that, and then dollar starts to drop from its fair value gap on its daily chart, this market here, this metal, will explode vertically. Like it'll like, see how you had this big down candle here? You'll see something like that on the upside. And then everybody on the fund level will start piling in, and they'll be buying it like crazy. And there you go. You'll see the beginning of a historic bull run on gold. But we got our 2,000 level, a lot of profit taking in here, and then we're consolidating. So a lot of people are trying to sell gold. They want to see it go lower. Imagine if you're trading what you think is my optimal trade entry, fair value gap closure here, and you're trying to get it to go lower, and you're just doing this. How frustrating would that be? I would not be holding gold short. Simply would not be doing it. You're literally going against every fundamental driver for this market to be going higher and way higher. I'm just giving you the next reasonable level, which is 3,000. And if it starts to accelerate with all of the problems that may be coming our way globally, not just in the US, then this metal and silver will literally go ballistic. Like it's going to be incredible. But you have time. You don't have to worry about it. We're watching a catalyst unfold in the dollar. And when that unlocks, then I'll talk more about gold. But what I just said here was basically what I would have said the other day, because nothing really has changed. Nothing has changed since the last time we did our market review. We're still in consolidation. We're still in this tight dealing range between this high and this low. So again, it's exactly what I would have said the other day, and that's what we're waiting for. We're waiting for dollar to sort out its dealing range on its daily chart. So once that works its way out, either on the upside or the downside, gold's going to stay in this range. Okay. And what else do I want to talk about? Let's take a quick look at soybeans again. And November contract. Consequent encroachment, low, high, bam. Whoop. See that? And all of that was based on those relative equal highs and market structure over here. Buy, 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 gone. Gap, extend it through time, extend it through here, support, rally. Like, these are exciting markets. Okay, when everything's primed to move, these markets are incredible opportunities because they're real markets. They're not manipulated. They're not. There's no central banks behind them, doing this and doing that, and they're driven by real fundamental drivers. And the last time we talked in mentorship, I was talking about how this coming boom in commodities and how it's going to be a food war. It's almost like Zero Hedge. Maybe he's in here. Okay, maybe the guy's in here and he's a mentorship student. I don't know, but it's just uncanny how if I talk about something, there's an article on their Twitter and or their website. And I literally read Zero Hedge. I think it's a good resource. So if you're wondering, one of those things that I like to follow, where do I get my news from? I like Zero Hedge. They are timely in the things they talk about. Usually ahead of them sometimes in the things I talk about. But they're seeing a lot of the things and the warning signs that I give to you all. So while I'm trying to play Oracle on a lot of the global things, there's a lot of things that I just don't care about, and most of it's politics and stuff. But because we're going into the election in the US, that's a problem for every country, whether you like America or not. It's going to be something that your country is going to deal with as well. So this food war idea that I've been talking about, and how food is going to be an issue, I talked about that in the earlier part of this year as well. And I mentioned that China would be a large buyer of that. Like they're going to be looking to feed their people. And there's all kinds of articles now after we talked about this that they are putting in huge orders for energy and food. So there's a lot of people in China, and they're buying up these staples with the idea of storing them for something. Now, the something may be war, or it could be just something that they know that's likely coming down the road. Food trouble getting food. So if you have the largest population on the planet, okay, and buyer of things like this, China, markets like soybeans are going to be really driven higher. And that's what you're seeing here. All of this is the effects of China and other countries buying this up. So is it the end of the move? No, as I mentioned in the last video. So all of this is just the beginning of something that'll be really obvious later on. And it'll be one-sidedness, where it takes a lot of skill to do this and outline these as buys. I wasn't able to do that when I first started in the 90s. Now, because I'm more refined, I can see these types of events unfold. If we start seeing the dollar break down and crash, then these commodity markets are going to go vertical, and limit up days will be a thing that we see a lot. Limit up days are where the market is forced to trade to its maximum limit, and you can't get in or out of it. It's scary if you're on the wrong side. And to be honest with you, it's kind of scary when you're in it and you're making money at the maximum, velocity, and you couldn't even get out to take the profit. It's a little intimidating. And I've been in a couple limit up moves and in down moves too. And I've been on the good side and the bad side. And I can tell you it's exciting even when you're losing, and it's exciting in a way that you can't imagine when you're winning. But it's terrifying all at the same time because you can't get out. That's what lock limit is. Like, there is no trading. It's just all buying. There's no liquidity to get in or out, and it's moved to its maximum incremental move that's allowed for that particular day. And in the 70s and the 80s, there used to be market moves where you could be 10 days lock limit. Imagine that. If you're on the right side of the marketplace and you have like 10, 20 contracts of whatever the commodity is. Like, that's awesome. You want to be in something like that. And that's the type of environment that we're going into for the end of the year and in 2021. That's exciting. But you don't want to be in futures contracts doing that because it's very, 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 very risky. And if you trade it with an option, whatever you put in plus the commission, that's the maximum you can have. Now, I had lots of emails come to me, not that I've been reading them, but when I have a meeting with my staff, I ask them all the time, what's the feedback you're seeing? What things should I be talking about? Because they go through and they skim through the emails. So that's why I tell you, don't really send me anything sensitive because I'm not the only one reading the emails. But some of the topics were, what brokerage would I recommend for trading commodities? And then we go right back to that in the beginning when I said with Forex, I'm not an introducing broker. It's illegal for me to do this, and because I'm getting paid to give you an opinion about markets. I'm only talking about it in demo or paper trading for my protection. So I'm going to use the same response I do all the time. Use whoever you trust. And if you do your research, everyone's going to have a problem. Every brokerage has, stories where it's a horror show. You see what I do here, and there's still people out there on the internet giving reviews that aren't true. So the point is, use your due diligence, and the larger companies are that way because of a reason. They aren't the largest, brokerage firms for, accident or coincidence. They're operating a business, and traders are going to lose money. And when they lose money, they're going to put bad reviews out there because they think the broker did it to them, and with trading commodities, it's nothing like it was when Forex started. Like, you don't have that problem in futures. Like, you either know how to trade or you lost your money. In Forex, there's individual liquidity pools with your brokerage firm, and that's by far and large the legal realm that they operate in. And you don't understand it, but when you open up your account, that's what they're saying. They're saying that, look, we operate with a spread, and you may not be able to execute your orders, or they may not fill because they're controlling the spread. So that is always going to be a problem with trading Forex. So you have to take that into account when you're trading it. Futures is a little bit different. It's kind of like you get what you see, okay? And it's take it or leave it. There's really not that big of a deal in terms of discrepancy across the board with the pricing. Not to the same degree that you might see in Forex still to today. But if you contrast that with how it was trading back in 2007, you could see 20, 30 pip variances in brokerage firms with Forex. Like, it was nuts. But you don't have that problem with trading futures. And you wouldn't have that concern if you were trading the options either. So we'll talk more about it. And I know a lot of people have been hitting my email saying, okay, can you talk, because they're afraid they're going to miss it. You're not going to miss it. Okay. It's months away. Okay. Just so you understand, it's months away. This is all the beginning of what might be coming. I might be wrong, and everything gets sorted out after the election, and all the COVID-19 stuff just magically disappears. All these things are just what's on my plate right now and on my radar screen. And what I'm seeing has the potential to be an explosive bull market in 2021 in commodities. That would imply terribly bearishness on the dollar. And I have to wait for all these things to start developing. And because we talk twice a week, that's plenty of time. You're not going to be blindsided by it. So just relax. All right. So talked about soybeans, talked about gold. Let's talk about oil. We haven't talked about oil in a while. And all right, so here's oil. Close that gap we were looking at. Drop down. This, again, if commodity markets are going to heat up, oil will eventually start to move higher. If we do another shutdown, okay, like Lockdown 2.0, the extreme level, or the Revenge sequel, then we could potentially see, again, all of this, again, occurring with oil. I wouldn't be trading energies, to be frank with you. If you're an oil trader, this is a really hard environment. I personally wouldn't be doing it. I would be trading something else. But all of this changes if we start seeing the things I've been talking about for the last 15 minutes or so. E-mini S&P. All right, let's zoom in here. All right, so we haven't had a whole lot of movement out of this range yet. I don't like it, to be honest with you. It looks very heavy. And right in here, it just looks too obvious. We still have a little bit of that gap. Right in here. So have 31.72 and 3/4 in mind while watching S&P. If this thing starts to drop lower, which is seasonally expected, I mean, that's a normal thing this time of year for it to drop down. This might be a level where we could see some sensitivity, but if we go through this hard, then yeah, we probably are going to come down below here. Okay, so I'm not bullish on this at the moment, and I would be expecting it to drop. I'm not saying go in here and sell short, but the way it's set up here, it just looks like it's having a real hard time getting higher, and it might just drift lower. And how we trade, if at all, to this level, that might be a level to watch for some sensitivity, and maybe some buying could happen there, or it would be just a bounce, go up into something that forms in this decline should it happen, like a fair value gap, bearish order block, something to that effect. It could just bounce from there and then set up another line of selling to go below here. Something to think about. Where we have in the past as a seasonal influence on spending, okay, because every calendar month in the U.S. there is some kind of holiday, okay, with the exception of August. And then in September, October, November, December, all these holidays are very heavy with commerce. Like, buy all your things for your holiday decorations. Well, this year we have social distancing, and don't come together in large crowds. Don't do this and don't do that. So we don't have a lot of the built-in buying, from a seasonal standpoint. Those influences aren't really apparent this year. So that makes this seasonal fall influence and seasonal tendency, plus it's an election year. So it compounds the difficulty. So this is why I've been, pounding the table all year long. This year, regardless of what you believe and how good you think you're learning, dial back the level of risk, because it literally can get nuts, and you don't want to get hurt financially. This is just one small segment of time that you have to endure. And it may be the best decision in the world for you to not trade at all the rest of this particular trading year, and then wait to see how we get through the election, get through the holidays months, and then start in January and do your soft start like we do in February, where we ease into trading again about the second week of February. We don't do any trading in January. We wait to see what the markets do and how the large funds work with the banks. So I'm telling you this because there's a lot of potential for it to get untradeable. But if everything unfolds as it usually does, we could look for some kind of a buying effect between mid-September to the second week of November in there, that seasonal low that forms in equities. I would not be comfortable with calling a low until after the election. In fact, probably a week after the election in the States. So I haven't said too much about E-mini S&P or stocks because of that. So that's the reason why I'm more or less not touching on the subject, because the more I talk about it, the more enticement I'm going to build in my audience. And I don't want you thinking that I'm going in here trading this, because I'm not. I am absolutely not touching equities. I'm not touching none of that stuff until we get something obvious, and it has to be on the other side of the election. So between now and November, all I'm doing is waiting. I'm watching. But if we get the index divergence that we look for post-election, then we'll have a session where we sit down and we'll look at the strongest stocks with undervalued stock options, and I'll give you the whole process there on how we can do that. And then you'll see. You'll watch and see if it pans out. But just know that this year is extremely complicated. Like I have never had this many variables, and the current environment is like, anyone that says, oh yeah, we got this figured out. No, you don't. Like there's so many potential opportunities to have a black swan event come out of nowhere and then completely erase you from trading. And I'm trying to avoid that in my own trading. And I certainly don't want to say something to entice any of you to do something that causes great hardship, because that's potentially what we're looking at. Like there's never been a time ever in history where the level of risk is so obvious. And you see these people out here trading, and every time you click on a YouTube video, and all my videos, you get these same people. Yeah, I'm going to make you a millionaire. It's nuts. And everybody wants to be trading right now. And it's just ramping up, lots and lots of selling the idea of learning how to trade. And it's almost like chumming the water. Okay, it's a fishing term where they put like fish parts and blood and such, not to gross you out, but that brings in the shark. And all this idea about, I'm the most successful options trader on the planet. I'm the co-founder of, Spit and Bull, or whatever he is. I know his name. I'm just not going to promote him here. But the point is, you see all these people, and they're promoting trading. And all that's doing is bringing people in that maybe have lost their job, but they have cash. They're thinking, well, I'll get in here and try this trading thing. And that means you have lots and lots of potential victims. So it could be real carnage here in a couple weeks. So just be mindful of that, respect that. And let's see, we've done soybeans, we've done E-mini S&P, gold. I can't think of anything off the top of my head. I know as soon as I close the video and the recording, it'll dawn on me. Oh, I should have talked about so and so. Yeah. Australian dollar. Aussie dollar. All right, so, wow, that's. Back here, some of you that live in Oz were freaking out, saying, "Can I pay for a mentorship?" I said, "Just wait. Now look where you're at. That's actually a good thing, isn't it?" So, on a short term, I think if I'm not mistaken, we have employment numbers tonight for Aussie. Let's take a look at that real quick. All right, so later tonight at 9:30, employment change and unemployment rate for Aussie. So we could potentially see some movement here in Oz. So where is the opportunity? This jumps out. right away. So we could trade down to that. It could be a buy. We didn't quite get consequent encouragement there. So there's some room to go down here and tap that again. So you can study that tonight. I like how we've already went higher than this one. So let's look at a 15-minute time frame. Ugh. See, FOMC really screwed this up. We don't have that much imbalance to work with, but cut through all of this noise. Okay, cut through all of this, and we have the bearish order block and consequent encouragement of the fair value gap. Again, they don't expire. So extend it through time around 73.15, 73.20. Watch, it might get some sensitivity there. And we have relative equal lows here. And below that, there's our line that we just had for the hourly chart. So lots of liquidity resting below here. Something to practice with tonight for those people that work in the States coming home after dinner. You want to stay up a little bit, watch some Aussie dollar, see what happens there. We had this high taken here, and this high has been taken here, here, and here. So a lot of this buy side liquidity has already been purged, and I think we've already dipped into this. All this is trying to work out a premium level as it's rising up. It might be done where we are here. It doesn't have to go up to this level, but I'd be watching it there and see if we can get a run down below here. If it doesn't go down here, don't build it up emotionally in your head. Oh, I got it wrong, because we're on the heels of FOMC, and this needs to be ironed out, and it may require all of trading tomorrow before it does. And what I mean by that, it needs to get another dealing range started and with another imbalance, and then we can work with that. Because right now, this is, to me, I like the idea of it trading lower, because again, I'm having that near-term bullishness on dollar. So that lends well to this idea and running down over here tonight as a study for you for Aussie dollar. All right, and let's just throw dollar CAD on there because I don't know, I got time to do it. I ain't talked about it in a while. Oh, sorry, I opened it up now. What a mess, guys. In Canada, man, I pray for you. All right, so we have maintained a really tight consolidation on this pair. And what a heart attack that is. I would not be wanting to trade this pair at all. Good gracious. Well, on the daily, let's see here. Near-term bullishness on the dollar, we could potentially pop up here and clear that. How we trade at that level, if at all, and through, sets the stage for a run on the liquidity right above this short-term high. What's the low here? 32.70, and the high here is, can't see, it's always in the way. 32.71, so yeah, we've already worked that out. But liquidity would rest above that. Relative equal highs have already been purged. Yeah. I just wouldn't touch it. This would be a no touch for me. I wouldn't be touching dollar CAD. Yeah. And I don't talk much about it, but let's look at dollar yen. All right, so here's the dollar yen. This is our daily chart. And I feel awkward even talking about this pair. I'm gonna have to take a shower when I'm done. The rejection block, be mindful of that. That might be an area where we get some reaction there. We're also trading below these relative equal lows. I hate this. I hate this pair. I literally hate this pair. Yeah. Just watch that rejection block. I don't think there's anything really more to say about it that would be beneficial to you. And again, this is the reason why I don't cover it. I don't talk about it. I don't like the pair. I don't trade it. And if I traded it, I would not have the hit rate that I have by trading like pound and euro, because it's just a very manipulated currency. Mike Swissy. And I think that's going to be it. I don't have much more to say about anything off the top of my head regarding any particular market. So just a little bit of housekeeping real quick. There is a ton of emails that it's stacking up like exponentially. So I'm going to have to create another email address. The email address I give you in the next mentorship video this weekend. Do me a favor and try not to share that one with anyone. And here's what I have in mind for it. A lot of you send me like these really long essays about, thanking me and a wonderful experience and all that. While I love those, you haven't got to where you are aiming to be. Okay, so it's almost like a warm-up story to what your eventual story will be when you hit your level of success. And I get it. You're overzealous and you're just really feeling like you're home. You found your place and you're in our community and you're learning. And that's great. I love that. But those emails are really, really, really long. And as of recent, I don't have a lot of free time to go through them and enjoy them. And some of you have made multiple emails in the past couple months because I haven't got to them or responded. So you feel like I'm not caring. I do care. But I also have to have my students that are here and you be able to prompt me with things they need more discussion on, okay, or to touch on topics. So going forward, what I would appreciate all of you doing is when I give you the new email address, I'm keeping Inner Circle Trader Gmail. That's always going to be associated with me. But because I get so much correspondence, even for people outside of this group, I want to make sure that I'm serving you better than I am now, because it's just, we're getting slammed. Like, it's unbelievable how many emails I'm getting. So to help filter that, the email address I'm going to give you this weekend, please don't share that with anyone else, because it's really meant for people that are here. And if you don't include your username, it has to match your email address. I will never respond to you. Okay, that will never be a response given to that type of email, because some of you just go right into saying, I need you to look at my trade. I don't do that. Like, I don't say, yeah, that's a good trade. If you took a trade and it panned out, that's a good trade. If you followed your processes and the things that you learned here and it was a positive, even if it was $10 profit, that's a good trade. You don't need me to tell you that. I would like for the email topic, okay, the line that titles the email, let that be a very short prompting of what you need or would like for me to touch on in a next video or within the next couple videos. Like, please talk about bearish breakers on intraday charts, or please talk about institutional order flow, or talk about commitment of traders, or could you please talk about mitigation blocks or vacuum blocks or something to that effect. And try not to be real wordy with the email, because if you send me something that looks like a text that's really short, it's easy for me to get that. I can see it, I can write down in my notes, and then I'll cover that when we talk in these videos. But if you start sending me like a dozen charts and you're asking me, can I grade your trading, I get it, I understand, and I wish I had that type of thing when I was coming up too. But there's so many of you, okay, so many of you that are trying to do that. I don't have enough time to do it. Like, I can't, there's no way humanly possible that I can do it. And I feel awful saying it like that, but it really is true. Like, there's so many emails coming in. It's overwhelming. Like, it's really intimidating, to be honest with you. And I promise that if you try to work with me in this regard, you'll see that it works a little bit better, and I'll be able to touch on topics a little bit more quicker, and it'll scratch that itch you have that you may be needing scratched by me covering a topic that hasn't been maybe touched on in recent weeks or months. Okay, so don't be put off if I don't respond to them. Okay, I'm not promising a response. All I'm saying is treat it like you're sending me a text, but it's going to an email, And whatever topic you need me to touch on, that's what I want to go with going forward. But obviously, if you have a technical problem with your account, use both addresses and title it urgent. And then whatever the issue is, then send an email, and then we will read those emails. But don't use that also to say, oh, and by the way, can you look at this trade too? Because I've had that too, and it's annoying to see people abuse the urgent, because when we see urgent, like, we're getting to that within 24 hours. Like, we're always panning for that. And if you don't have your username in the email and it doesn't match the email address, I don't know who you are. And I'm not gonna converse with you. I'm not gonna give you a response, and I'm not gonna coach you through something if you haven't shown that you're here on good standing as a mentorship student. So anyway, I've taken a lot of your time today, but I've covered a couple different markets and some ideas and shared some things. And I think that's going to be it for today. So just make sure you're studying cable tomorrow. And let's pull that up real quick, see if I got stopped out yet. And let's drop it into a 5-minute chart. All right, so it's just meandering around. It could probably go up there and stop me out, and that's fine. But nonetheless, that's the next heavy hitter for tomorrow, watching British pound versus US dollar and its rate announcement. And that will look like this. We have at 7 a.m. New York time, official bank rate. And Canadian dollar has a little bit of stuff, but again, I wouldn't touch CAD at all in here. And then Friday, we have retail sales for GBP at 2 a.m. for London session. So whatever we put in motion tomorrow with the rate announcement for GBP, I would anticipate the continuation of that idea or narrative on Friday at 2 a.m. All right, so that's the business, and I will catch up with you obviously by way of a YouTube video tomorrow and on our weekend edition Friday night. Until then, be safe and good luck and good trading.